Hey everybody, it is Brent. It's been a little while since I've had a video out. I've had a lot of 12 to 16 hour days over the past 2 months on the subscriber website, so I've taken the weekends to kind of just rest up. But I did put out a post that was on YouTube. It wasn't a video, it was actually a post that you could read, and I hope you check that out. And we have the S&P 500 over here. Here's our COVID crash. Here's the Fed throwing everything at it. A little bear market, and then we had some lows in October of 2022 that led to this rally where we're coming up and challenging like just 0.1% really off of the record high from late 22 right over here. So we have really frothy sentiment, and a question I get asked a lot is, what do you think of this rally? Did you think it was going to be this strong? So I definitely thought we were going to have a rally. Let me show you this area, because here is basically where we called the low. And we had the Dow lead off of this, and then it was just all the mega caps that took over in 2023. So one big difference I'll tell you right now that I noticed between now and this time last year was this time last year, the mega caps, let me pull up MGK for the mega caps, they were getting sold really hard down here. They were like the most hated stocks of 2022, and the reason why was because interest rates were going up. But we could see them. So there's like a lot of tax loss selling right here at the end of the year. We could see them being accumulated on 3C, and all of a sudden, the most hated stocks turned into the only game in town. That has changed. That changed as of October. So I have a video called Cracks, and it was about the mega cap leadership starting to fade and fail. And that's been the case. This whole move over here has all, let me pull S&P 500. Hasn't been all short covering, but it's been mostly short covering over here. We'll take a little closer look. First, I want to bring you back to, for subscribers, you can check this out. It's the daily wrap from September 5th. So you can pause this and just read it, or I'm just going to read it real quick. Remember, this is September 5th. That brings me to my thoughts on the rest of the year. The S&P's head and shoulders isn't going to put in a new bear market, but I do think it will do enough to break the market's uptrend rally and eventually will trade lower. The S&P's measured move from the break of the neckline is around a little under 6%. The neckline is modestly upward sloping, so the price target shifts every day, but generally it's around 40.80 at present. I'm guessing by the time it actually breaks the neckline, we can probably call it 4100. The S&P broke the neckline, and it traded within 0.1% of 4100 in late October. So that was a good call on that head and shoulders. Okay, so here's the second slide. This is just below what I was just reading you again from September 5th. You can look at the price chart and see where price was. We were very early in September, and this was my hypothetical drawing of what I thought would happen the rest of the year. And notice there's a Santa Claus rally right into the end of the year. So reading it real quick, the first red arrow represents price moving back down to the neckline right over here. Like transports did today, there's usually a brief pause or consolidation or correction. That's this little green arrow. And the measured move is 4100, which is right over here. At which point that trend is over. That head and shoulders measured move would have been met. It could be over on the move down to the neckline. From there, we get into a seasonably favorable time of the year. Election, Santa Claus rally. The economy is likely weakening more at this point. By then, there will be chatter about the Fed cutting rates more aggressively in 2024 or sooner. That was my call. We'd have a Santa Claus rally, and the Fed would start talk about cutting rates, which is actually what boosted this rally. So let me show you the S&P real quick. And this was the December 22 record high, which is actually like a little top right here. And then here we get into the bear market. So remember, we had a bear market in 2022. These are counter trend rallies in a bear market. And this is where we called bottoms. The Dow had the nicest bottom in October 2022, but the S&P actually had a little inverse head and shoulders that kicked off our rally. Mega caps rotated in right here, drove the S&P higher. Here's that head and shoulders I was talking about. So I'm going to zoom in on that a little bit more. And September 5th, when I was talking about that, would have been this day right here. So that was the daily wrap of this day. My call was we would have a head and shoulders, break it, we would back test it just like we did here, and come down to 4100. Then we would get into a seasonal part of the year. I didn't think we would get this strong of a rally, but like I said, the Fed surprised and they started talking about cutting rates, and that didn't happen until FOMC in December. So I'm going to show you that real quick because it's worth talking about. But most of this over here is short squeeze. This little part above 4,600, I think, could be a bull trap. So we have to be really careful. Everybody's super bullish right now. You have to really just put your emotions aside and go with probabilities. For my subscribers, we're talking about that extreme sentiment. Could it get frothier? Could it go on for 2 more weeks or another month? Absolutely. Will the S&P make a new high? I can't see how it couldn't. I mean, it came like within 0.1% of a new high, which is right up here. I think it will. But let's take a little closer look at what happened with the Fed real quick. So again, hopefully you can see this. Headlines, right? U.S. Fed Chair Powell says it's premature to speculate on rate cuts. That's December 1 of 2023, just a month ago. And then here's December 13th. So 2 weeks. Fed policymakers discuss timeline to start rate cuts, Powell. So within 2 weeks, went to premature, staying hawkish, to talking about cutting rates. That's the pivot. That's the dovish pivot from the Fed. I'm going to show you a little stuff back in history. We can look at the Dow, we can look at the S&P. Anytime the Fed surprises the market dovishly, almost any time, and especially if you're in a bear market, if they surprise dovishly, you're going to get a strong rally. This was a surprise. So this is a tweet from the Wall Street Journal's Nick Timiraos. They call him Nicky Leaks. So he's the Fed whisperer. Anytime the Fed wants to get something out, they use this guy. And they'll leak it because most of the time the Fed doesn't want to surprise the markets too much. This Fed, anyway. Powell's much different than like Greenspan was. But this is his tweet. The Powell pivot begins December 1, that headline I just showed you. It would be premature to speculate on when policy might ease. December 13th, rate cuts are something that they're beginning to talk about. And this is what Nick says. What a difference 2 weeks can make. I expected this to be happening around this time because of my timing for a recession, when I think recession is going to hit, which is in 2024. What this did for the market was we were already down here at really oversold levels. And what I was telling subscribers by this time was like, look, we're meeting the measured move. I don't have any expectations of further downside beyond the measured move. Usually we get some kind of bounce or a consolidation or something will happen here, but usually you won't see prices go much below that. This wasn't a big head and shoulders top, but it was a head and shoulders top, and it did meet that measured move at 4,100. By this time, I was telling my subscribers, look, this is a really, really bearish sentiment because we had 3 months of nothing but a sub-intermediate downtrend. I wouldn't enter new shorts here. The market's way too oversold. If you have shorts on, manage them, but I wouldn't enter new shorts here. So as oversold as sentiment was here, it's overbought and really frothy up here. But if we get that December meeting right there, you can see this is when Powell and the Fed surprised, and we got this really strong move that brought us up towards that new record high. I'm going to show you a couple instances in the past where the Fed is surprised. So this is a little different charting system, but I love it because I can go all the way back to like 1916. But this is the Dow Jones Industrial Average as of September 4th, 1929. So we're nearing all-time highs here in the Dow, and we're getting ready for that 1929 crash. And here's the crash. So the Fed did a couple things: emergency rate cut, Fed injects liquidity, but the actual bottom of this crash and the start of the first rebound or counter trend rally or bear market rally was right here, where the Fed surprised the market and cut interest rates more than the market was expecting, cut by 50 instead of 25 basis points, and we get this big 6-month rally off of that. So if you look at anytime the Fed is surprised, you get a rally like this. Let's take a quick look at the S&P back in the great financial crisis, which almost turned into a depression. And here's the S&P 500 rolled back to July of 2007. So this is before the record high is put in, which was October, and before the great financial crisis. But stuff was already coming on the table. Concerns about Bear Stearns, and we didn't get to Lehman yet, but you can see the discount rate was cut over here, and that started a rally. I mean, literally on that day. And then we make a new high in October, and that's the record high. right? And the Fed's already into a cutting cycle now because they can see trouble coming. But what I want to show you is, we have a couple 25 basis point rate cuts, and it doesn't do anything for the market. The market goes down. The Fed did not surprise the market dovishly. We get down here after a nice sell-off, and what happens? Right over here is a 75 basis point cut. We get a decent bounce. They cut by another 50. The market comes down, and then we get another Fed surprise. So these two surprises spawned rallies. The second one was a little bit bigger, almost 2 months. And then we get into kind of the meat of the financial crisis where Lehman fails here, and you get into a really ugly bear market. The Fed cuts rates down to 0. The Fed funds rate starts buying assets and all that, and soon we bottom out in March. But the point is, when the Fed surprises, the market rallies, and these are pretty decent rallies. Let me see what this one is real quick. So it's almost 12%. So we've seen, I think, the SP rally about 16% or so. And most of that was on short covering. So here we are back in the present or near present around September of this year. The head and shoulders top, the breakdown, the back test, and then meeting that target at 4,100. And here comes the seasonal rally, the Santa Claus rally. The Fed hasn't done their thing yet. What I do want to show you is the extent of the short covering in this rally. So everyone got really bearish, not because of how much the market had fallen. It really hadn't come down that much. Like if we look at this area here down to, let's say down to the October low, it's not a huge decline. Let's see, it's about 9 or 10%, right? But for some indices like the NYSE, remember mega caps have just run the show most of 2023. We've had a lot of indices like the NYSE and IWM that actually went red on the year over here. But what really drove that bearishness was 3 months of just trending down. So every time the buyers would try to buy, they would get slammed. The short sellers were just piling in. By right over here at the end of October, according to Goldman Sachs data, hedge funds were the most short they have been in Goldman's records of keeping tabs on that, which goes back to 2010. So you have major short interest, and it's just waiting for a short squeeze. I want to show you my most shorted index because I've never seen anything like this. We got, okay, so here's the S&P in the candlesticks, and this is my most shorted index of stocks. It's an equal weighted index. This short squeeze alone, the first one, there's actually 5 major ones. 1, 2, 3, 4, and 5. This is the Fed right here. But this one alone was the largest in years. And you can see what hedge funds did. They shorted it again. Came right back down. The hedge funds got squeezed a second time, a third and fourth time. By this point over here, the hedge funds have pretty much covered all their shorts, and now they're chasing these stocks, which were the crappiest stocks out there. A lot of small caps, regional banks, airlines, biotechs, non-profitable tech was a big one. A lot of those in this most shorted index. They started chasing those and buying them because they wrecked their year. They had been so short, they got squeezed, they were wrong positioned, wrong-footed, and they wrecked their year. They covered, and I think they just started chasing. Here is when Powell went dovish, and you can see another monster short squeeze. So we have 3 of them here that would have been the largest in a couple years on their own, but back to back to back to back to back. So major short covering, which in my opinion is like a sugar rush. It's not the same quality of buying that we saw earlier this year or late last year or this time last year when the institutions were buying the mega caps. It's not like that rally from January up to July highs, where there's actually a lot of breadth, a lot of good breadth in the market, and a lot of strong moves by the mega caps. They lost that leadership in here. I haven't seen any leadership from them. So what we've called this rally, or what I've called this rally, is the dash for trash, because it's basically all those really most shorted stocks that got squeezed, and then chased higher on momentum. So the hedge funds could basically try to save their year from this kind of F up, screw up. In any case, right now sentiment is getting really frothy. The market is super overbought. As oversold as it was by late October, it's that overbought now. If you look at CNN's Fear and Greed Index, and it's only good for one thing, when it's at extreme highs or extreme lows, it is up into extreme greed. And every time we see that, the market has like some kind of correction or some kind of deep pullback. So when the market was up here and put in this key reversal day in July, and it had made the high for the year right up here, we were in extreme greed on that fear and greed index. And when we got down here, we were in extreme fear. So now if we roll all the way forward again, and we're coming up on that record high, it's in extreme greed again. And every time it's in that area of extremes, it's a contrarian signal, meaning everybody's on one side of the boat here. Just like all the hedge funds were short over here, they got squeezed. Now everybody's chasing the market on the long side. And when you get too many people on the same side of the boat flips. That is what that is really good for. And if we look at IWM, because I did talk about small caps, and here's a daily chart of IWM or small caps, and you can see this big range they were trading in, and they actually went negative on the year, down by 6% by late October, because it was the mega caps driving everything, not the small caps, right? So if we look at that, or we look at the NYSE, I think the NYSE was down about 2%. Global stocks had given up all their year-to-date gains at this point. This is where we get all those short squeezes right here. But if you do look at the fear and greed index and you look at IWM, it's almost like an oscillator. Almost every time it's like we'll be in extreme greed over here, extreme fear over here. And this is another reason that I thought we were going to get some kind of move into year end, is because it was coming down to this multi-year support. It's doing something almost exactly like it did in all of 2021. I'm sorry. Let me show you. And you can see this really sideways. So this is actually a primary lateral trend. So a primary downtrend is a bear market. A primary uptrend is a bull market. Stocks move three ways. They move up, they move down, and they move sideways. And that's what we have here with small caps. But I want to show you something. Same thing happened in 2021. So we had the mega caps lifting the market to new highs. They were trading in this same kind of small lateral range. They only broke out of it at the very end of the year. You can see right here, this is November, right into December. Almost same thing as what they're doing right now. That breakout failed. The S&P, the NASDAQ, all put in tops here, and we entered a bear market off that new record all-time high, which, by the way, was extreme greed. Same thing we're seeing right now. So it's an interesting little parallel, this range of doing nothing, trying to break out, and that was the end of the bull market. And we entered a bear market. And we have the same thing here, just bigger, the same range, trying to break out right here. Sentiment just offsides. As a matter of fact, I'm just going to walk you through one of my recent subscriber posts. This is the daily wrap, December 19th. If you're not a subscriber and you want to see what I do, this is one of about 5 posts a day. But this is at the end of the day, after I've gone through everything, run my scans. Daily wrap, you can kind of get an idea of what I do, and talking about liquidity here. So this is the Fed's reverse repo. Still liquidity in the market, a lot of liquidity that has been supporting the market, but it is coming down real fast. This is expected to tap out in around March. So this is offsetting their balance sheet shrinkage. Let's keep on going. Here's where I'm talking about we're just getting into really, really extreme oversold breadth. These are the crappiest stocks, by the way. And this is the most oversold they have been in October, late October, since the bear market bottom in October of 2022. So I'm showing them that and how we're getting into really extreme overbought territory now. 3C, we had really, really good confirmation in 3C of this rally off the October 27th low. You can see it over here. What happened was I said, I think things are going to get a lot different with the S&P moving above 4,600, and I think it can set up a bull trap. And what did we see? Look at this. 3C goes from confirming really well. S&P trades above 4,600, and 3C is negatively divergent. So we had really good support with all those short squeezes over here. Over here, this dash for trash after the Fed pivot and all that, not so much. So I'm going to just really kind of skim through a lot of this, but you can get an idea of what my nightly posts look like. There's another thing, volatility's term structure right now. is in super deep contango. Usually when it is, these bars are painted red. It's like a high. So you can see this is our head and shoulders top that was forming. There's the head, there's the right shoulder, and here we are now. So extreme contango. This again says that investors just have no fear. Everybody's bullish. And we have that extreme reading in sentiment, like really frothy bullishness, kind of almost like late 1999. Anyway, I'm going down to the bottom of this post. I start talking about the fear and greed index. Again, I have no use for this except when it is at extremes. Extreme fear over here, or extreme greed. This is as of the day of this post, so it was in extreme greed. It's still in extreme greed. And then I lay this out on a chart. Actually, this is over time. I mark the areas here, extreme greed, extreme fear, and here we are over at the present scenario. And then I've marked them all on the chart, on the S&P's chart, where that indicator went into extreme greed. And the market comes down. Extreme fear, we get a rally. Extreme greed, the market comes down. Extreme fear, we get a rally. Extreme fear, we get a rally. Extreme greed. What do you think is going to happen next? I know everybody is super bullish, but the market is not about how you feel. It's about probabilities, looking at the probabilities. So every time we see that indicator do that, it doesn't mean it's going to be tomorrow, but it means you're in a danger zone. So the shorts were in a danger zone here at the end of October. That's why I was saying to everybody, no new shorts, just manage what you have on right now. And then I actually just go through and I break down all these dates, like what was happening there, just so you have some idea. Mass psychology, mass sentiment, it matters. It really matters, because when you're reading price, it's not just about trend lines. When you really have a lot of time in reading price, what it's about is mass psychology. That's what moves markets. So I'm sure you've heard there's two emotions that move markets, greed, fear and greed. And it sounds very basic and very beginner, but it's very true. In any case, if we keep on scrolling down, you'll see exactly what I told you in the beginning of this video. I think that we might be getting a double top. The head and shoulders pattern over here was not big. It didn't have a huge measured move. It just said this uptrend right here would break, which it did. We got a really strong seasonal rally. This is the kind of thing that is an appropriate size top for the extent of this rally off of the COVID crash lows. You can even see what my comments were, and my feelings have not changed on that. We're not there yet, but the big picture outline looks like it's being fleshed out. My thoughts on the macro environment are the same. So my call in for 2023 was that we would get this rally. The mega caps would really drive it in 2023, which they have. And then as we get towards the end of the year, the Fed is no longer going to be worried about inflation, but they're going to be worried about what taking the Fed funds rate from 0 to 5.5% is going to do to the economy, because there's a lagged effect on that. They say 18 to 24 months. That means a Fed rate hike today isn't felt in the real economy for 18 to 24 months. I don't think it's quite that long. That's why in early September, I was projecting, and I've been projecting this for over a year, that the Fed was going to make that dovish pivot and start talking about rate cuts in 2024. They've defeated inflation, in my view. I mean, could it come back? Sure, it could. I don't think it's a big risk. But now what they're going to have to do is turn and face the consequences of fighting inflation. Inflation is far worse than a recession in normal times, but we have this everything bubble, so who knows? But a year before the Fed even started hiking rates and inflation was going crazy, I was telling my subscribers, the Fed will fight inflation. They don't care if they cause a recession, because inflation is a much bigger problem for them. And it will come at the cost of a recession. So if you look at the yield curves, again, this is just probabilities. So a big part of this rally that we're getting into December, the Santa Claus rally, the second half of it in December, has been about that Fed pivot. Like I said in the beginning, surprises. When the Fed surprises, the market rallies on that. I'm going to show you the title of my post that night. So December 14th, this is Wednesday. This is the night of the Fed doing the pivot. The stock market has no clue that the Fed just told us that they're positioning for recession fighting. Again, this has been my call for a long time. Inflation is coming down pretty fast now. the effects of all those rate hikes are filtering into the economy. They're lagged, they take a while, but the Fed also knows to fight that, they have to get ahead of it. So whatever rate cuts they do are going to take a year to 2 years possibly, according to Fed studies, to affect the real economy. Right now, nobody can imagine a recession. It's very, very hard because everybody's super bullish. The market has rallied for 2 months. It's the same thing as when we came off the July high and the market did nothing but trend down for 3 months. Everybody got too bearish. 4,100 was our target. Hit that target and the whole market turned around. But like I said, you have to put aside feelings and what you hope will happen and look at probabilities. So let's take a look at the yield curve. Okay, I hope you don't mind. I'm just going to take you through another subscriber post from November 30th so I can bring up this chart. But again, if you're not a subscriber, you can see a little bit of what I do. Here I'm looking at those short squeezes, talking about those short squeezes, how big they were. Again, remember that date, November 30th, right? Short squeezes. So let's get down to the bottom where we get into the meat of this. This is the daily wrap, the post that subscribers get every night that the market's open. Here's the chart. Okay, so this is from the Fed, the St. Louis Fed, and it is the 2-10 yield curve. Let me see if I can zoom in on this. And actually, this is the 3-month 10-year yield curve. Okay, same thing, does the same thing. The Fed prefers this one. That's the only reason I use it. I kind of prefer the 210, but it doesn't matter because what will happen is a lot of yield curves will invert. What you see is the yield curve. This gray area here is recessions, okay? And what these red arrows mark is the yield curve inverting. So you can see what happens like clockwork. The yield curve inverts. That's a warning of a very high probability recession. I think inversions of the yield curve have called every recession in the U.S. since World War II, some even further back. But it inverts first, this red arrow, and then it sharpens steeply. That's what this highlighting is. So this is the warning of recession, but it's usually about 15, 16 months or so after that inversion that you actually get a recession that you can see here. And the really big warning, like the red flags going up, is after the yield curve has inverted and it starts to steepen really sharp. Recession, it steepens right into a recession. Here again, inverts, steepens right into the dot-com bubble. Here again, it inverts and it steepens real sharply right into the financial crisis. Even COVID, even the COVID crash, it inverted and it sharpened steeply right into that little mini recession we had, and then we have now. So this is the yield curve now. It's inverted. My thing has always been, I wonder how it's going to sharpen really steeply, because the reason it sharpens really steeply is the Fed is cutting rates. And by the time we were looking at this, the Fed was still on, we're not cutting rates, we're still staying tight. We might do some more rate hikes, we're not sure. So in my mind, I was wondering, how are we going to get that really sharp steepening without the Fed cutting rates? Because this is telling me recession in 2024. How do we get that really sharp steepening? Well, the Fed just came out and told us they are going to cut rates in 2024. They're talking about it. The market's already priced it in. That will steepen the yield curve sharply. Okay, and that will steepen it right into a recession. So that's still my view on 2024. I don't care how bullish the market is right now on short squeezes. You have to look at probabilities every time this thing inverts and then steepens right into a recession. Here's our current 3C trend chart that tracked this rally really well, confirmed it all the way up until we got into the S&P 4600 area over here, and there's the Fed going dovish, and this is what we have now. It's getting really sloppy. As a matter of fact, this area was one of the biggest sell programs in the NYSE that we've seen in probably a year. And this kind of divergence is what I call the alligator jaws of death. Price is almost always going to follow this down, this divergence. Is it going to happen tomorrow? Is it going to happen, a week from now? I can't say that yet. I can say this area got really nasty. What I told my subscribers was, first, that this was a really important day. So this is December 20th, big ugly day. This is where we had the biggest NYSE sell program run. So this was a really nasty day right here, key reversal day. This was every bit as ugly. It wasn't a key reversal day, but this led to a 3-month downtrend. So what I told my subscribers was, look, we're in, because this is December 20th. So we're in the week coming up to Christmas. The market is not going to tank right before Christmas. And I said, look for this price pattern called a falling three methods. If you're familiar with it, you know that it's actually something that's in a downtrend. But I'm trying to give them an idea of what to look for. So let's look at this post again. You're seeing a lot of subscriber content right now, but I just want to show you. So this is the daily wrap from December 21st, the day after this happened, right? And I'll move forward one bar. So it was the night of this day. And I'm going to just jump right to what I'm looking for. This is what I told my subscribers to look for. So this was the December 20th day. I said, look for something like this. Not that it is a falling three methods pattern, because that's part of a downtrend, but that you would see small bodied candles kind of trade up like this, right? So let's see what happened here. We take a look at the S&P. We'll zoom in a little bit and move forward. We get that same kind of pattern right in here as I was talking about in this daily wrap. It wasn't going to be 3 days because we had, 5 days until Christmas or so, and then we have the end of the year. So that's exactly what we got. That's what we were looking for, which is just a bunch of weak price action on weak volume. It's not surprising being that everybody's gone, but we're also in a very, very frothy time in the market. So I think 2024 is going to get real interesting real fast. Do I think it's going to sell off the first day of 2024? I don't know. I have to really see a little bit more. But so far, we had a really strong trend. The market's kind of petering out a little bit over here, approaching that 4,600 level, and boom, there's Powell. And we get the rest of this. Again, another big short squeeze right there. And I think the shorts are pretty much dried out here. I don't think they have a lot left to offer. But you can't really make a new high unless you know what stocks, what sectors are going to lead. And if the market truly, truly believed that we were heading into a soft landing or a new economic cycle beginning, then you would see the cyclicals being bought up. You'd see small caps being bought up. But instead, we look at IWM and it's nowhere near its high. It's way down here. The defensives got short squeezed. The mega caps have just been along for the ride since November. Their leadership is gone. And that's a big difference from this time last year when we just knew that the mega caps right here were being bought. As everybody was selling them, tax loss selling, institutional money was buying them here. 3C was going nuts to the upside. It was like, well, we know what's going to lead in 2023, and the mega caps did a fantastic job. But their leadership is petering out here. I don't see any sectors that are getting that kind of attention that we saw in December of 2022 heading into 2023. So I think it's going to be a really interesting year, really fast. I think a lot of people are overly bullish here in sentiment, and I think they're going to be surprised really fast. But as we get into the year, yes, I do think there's going to be a recession. Nobody can see it. Nobody has it on their radar. But you look at historical probabilities, not feelings, historical probabilities, whether it's the yield curve or whether it's the Fed funds rate, probabilities just rule. So let me show you one last thing, and then we'll wrap this video up. I'm just going to pull it from another one of my daily wrap posts, my subscriber posts. This is just the end of the day post, so there's a lot of content you'll see in it, but I do 5 or 6 posts a day usually. And I'm just going to pull up the last time that I talked about it. And this was actually the day of the Fed. The stock market has no clue. The Fed just told us that they're positioning for fighting recession. And let me find the Fed funds rate chart. And this is down towards the bottom of the post. But if you want to look at the content, you can take a look. This is a quote from the prior night's daily wrap before we went into the Fed. The question to ask yourself is, why would the Fed cut rates with inflation still running above target? I provided you the most probable historical answer in last night's daily wrap. And this area in blue is just the quotation from the prior night's daily wrap. The Fed is done hiking rates. The Fed hikes rates over the last 12 months. They haven't even hit the real economy in full force yet. So all of this stuff is like really predictable. Remember when I showed you the post earlier in this video from September 5th, I think, and I said, I think by the end of the year, the Fed is going to start talking about cutting rates, right? This is the reason why. I'll show you exactly why. Let's zoom into this chart. This wasn't my feeling or my prediction or my guess. It was based on this chart. So we have the Fed funds rate in blue. We have the 2-year yield in red. Again, these gray areas are recession. So there's the dot-com bubble popping. Here's the great financial crisis. Here's the COVID crash. And what you see is a Fed rate hike cycle here in blue. You can see it over here. You can see it here. You can see it here. The Fed hikes right into a recession. You can see it here. Happens every time. Then what happens is the bond market tells the Fed they went too far, and the 2-year yield here in red crosses below the Fed funds rate. I've highlighted it in red right here, when it happened here, when it happened here, when it happened here, when it happened here. The very next thing the Fed does when that happens is they pause that rate hiking cycle and they cut right into a recession. Pause the rate hiking cycle after the 2-year yield crossed, cut right into a recession. Over here, pause the rate hiking cycle, cut into a recession. What happened with the 2-year yield earlier this year? It crossed below the Fed funds rate. What did the Fed do? They paused rate hikes. What's the next thing they'll do? They'll cut rates into what? A recession. So again, these are just probabilities, and you see them over and over and over. It reminds me of that quote from Sir John Templeton, legendary investor. The 4 most expensive words in the English language are, "This time is different." So let that bake in a little bit. You can check all these things out on your own. You can go to the St. Louis Fed's website. You can see the Fear and Greed Index. Look at it on a chart. See what it's done. These are some of the most reliable and predictable patterns that you will see in finance. They happen over and over throughout history. So right now, everybody's super bullish. This time is different. I'm here to suggest that 2024 is going to surprise a lot of people. So let's leave it off there. I'm going to get more videos out to you guys. And for subscribers, we're moving to the new website. We will have the Discord room. That will shorten my days a lot because we can just chat right there in Discord. And any questions you have, we can go over all this stuff in real time. So if you haven't subscribed, take a look at our content. I post some free stuff. Check it out. Maybe it's a good fit for you. Maybe it's not. But a lot of content. And like I said, I don't go off of my feelings. I don't go off of what I'd like to see happen. I look at probabilities. Probabilities. What is the highest probability? And for 2024, I think the highest probability is a lot of surprises are coming. So I'll leave the information in the video description about the website, the current website, which you can still get in before the prices go up with the new one, and the new website, which is online right now, so you can check that out too, and there's some free content there. Everybody have a fantastic new year. I hope everybody stays safe, healthy, and happy, and I'm rooting for you guys.